It's my pleasure to introduce today's speakers, Luca Rusecchio and Waldo Saville from Efficio. Gentlemen, over to you.
Thank you very much, Jill. Hello, everyone, and welcome. Thank you for taking the time to take part in this webinar. My name is Luca Rusecchio. I'm a senior manager at Efficio. Been with the company for just over 7 years now. My role is largely that of an engagement manager, meaning I lead client teams from the identification of improvement opportunities with our clients in the realms of procurement, obviously, all the way through to their implementation. So I work closely with procurement and finance teams alike, and I'm therefore very much exposed to the daily challenges a vast majority of organizations face whilst trying to move from PowerPoint savings to actual or realized savings later down the line that actually affect the bottom line. So today I'm very much looking forward to sharing some of the insight I've matured over the years. Waldo, over to you.
Hi, I'm Waldo Saville. I'm a principal in the New York office. I've been with Efficio now 10 years. I manage and drive a lot of our business in the industrials and manufacturing. I also oversee several projects. Have also implemented savings tracking solutions of all types in many of my clients, and actually sponsor this practice within the company as well. So looking forward to today. So before we begin with the contents of the webinar, I want to spend a minute introducing Efficio for those of you who don't know us directly already. We're the largest procurement and supply chain consultancy with operations spanning across the globe, with offices in the main business markets in Europe, North America, Middle East. We employ around 500 consultants with 40 nationalities. We work across most industries, and we are able to deploy quickly in any part of the world rapidly.
Thanks, Waldo. We are framing today's conversation around the age-old problem and the classic scenario we are presented with almost every time we work with our clients, which is, on the one side, we see procurement teams claiming a certain savings value or amount, and on the other side, typically a certain amount of time later, depending on the various reporting cycles, we see finance only recognizing a fraction of the claimed amount. Now, this can ultimately create a disconnect between the two functions, which can at times lead to mistrust at the detriment of the entire organization, but more so to procurement, whose credibility is in a way stained. We know procurement teams can deliver value and do deliver value, provided they are included in the end-to-end process, going from understanding the business requirements and needs to managing the contract or the category later on in the process at the other side, the other end. This is important because one of the catalysts causing the disconnect between these two functions usually boils down to a general misalignment in the taxonomy and expectations set out by procurement, both in terms of the value, so what procurement promises to the business in terms of benefits, and timelines, so when these benefits will effectively impact the various financial statements of the organization. Now, allow me to depict a very simplistic procurement process just to make our point better. In a given year, procurement teams will run a series of initiatives requiring some baselining activity up front. That's the amber bar just before that, or the gray bar on the screen, meaning we need to estimate what the business could be spending in the future, as that will be the starting point from which benefits can and will be calculated. So understanding what's happened in the past and what the business needs going forward, so that we can estimate what the likely spend curve in the future will look like. Now, fast forward until several initiatives are completed by procurement, and there'll be an implementation phase, a transition phase to business as usual, where the relevant changes may be straightforward to apply or more complex, depending on whether we're just updating or refreshing unit rates from an incumbent supplier, or whether we need to onboard a completely different supplier that requires new product testing, which is clearly more challenging from an operational standpoint. Lastly, we get into the category or contract management phase. That is where organizations as a whole look to work towards a common objective, be that a spend target, a savings target, or a benefits target, more broadly speaking. Typically, here is where we experience the disconnect I was talking about earlier. This is where the disconnect is measured and where credibility is potentially lost or damaged, which is why procurement teams are generally put in to work on value generating initiatives. Now, both Waldo and I have worked with tens of clients, and the points of failure resulting in the paradigm I described in my opening slide seem to always be one or more of these four. First and foremost, the way the baseline was built. As I said before, the baseline is the starting point. If that is miscalculated or not aligned with the business and finance, it will have a ripple effect throughout the entire process, obviously. Secondly, the way benefits are estimated, so the calculation methodology behind estimating the future benefits. Third, the way the implementation is managed. And lastly, the way the benefits are tracked. We'll now dive into a bit more detail within each one of these four elements to flesh out some of the common pitfalls and ways of working around them, starting obviously with baselining. Now, baselining effectively means understanding the business's needs for the next period and estimating their cost as if no procurement process were to happen. This is the base principle behind estimating the benefits generated by the function. Because procurement did A, B, and C, the business either spent less or earned more or reduced process time, etc., etc. Unfortunately, this process is not an exact science by all means. It requires a lot of alignment with other business functions to make sure that the objective is common and shared. A baseline could be as simple as last year's volumes times prices, or as complex as having to make several assumptions on what future demand will be like. Whichever the case may be, keeping the dialogue open with the relevant stakeholders is once again very important. Just an example that comes to mind is we see this all the time with professional services or consulting, these types of categories, where the demand for consulting or services in general may vary significantly from year to year, depending on external factors. So agreeing a baseline will prove tricky, to say the least. But nonetheless, this is something that procurement needs to work through with, as I said, the business and finance to come to common understanding. Again, not an exact science, but there needs to be some form of alignment to this end. Index-linked commodities, another one, obviously whose price volatility is by definition exogenous to the organization. So a great deal of alignment will be required to build a baseline that it's believable. Once again, not an exact science. We'll never get all baselines 100% right, but that is not procurement's role, and we'll see that later in the tracking phase. Moving on to the benefits estimation phase, agreeing a calculation methodology with business and finance is critical. And the theme around speaking the same language as finance, also very relevant. Reports coming out from procurement showing delivered benefits need to be trusted, as this is how procurement demonstrate, or rather quantifies their contribution to the rest of the organization. What you see on this specific slide are different ways to calculate benefits that hopefully encourage you to think more broadly at the type of value procurement can enable. Some of these elements will be much easier to sell internally to the business and finance, as they are easier to be understood and evidenced in the various financial statements. Others will be harder and considered soft savings, but nevertheless, if we as procurement professionals are striving to elevate the function to a serious value contributor, we need to become fluent in promoting our capabilities at 360 degrees. So again, just to provide an example, if we're talking about unit price reduction or rebates, which are more tangible and widely accepted, this will be easier to get approval from the business and finance, and to find an agreement and alignment. Whereas considered soft savings such as demand optimization or cost avoidance may require a lot more work and more stakeholder engagement and management, as they are derived from a change in the business ways of working. For example, being I recently worked in Saudi for a company that operates and maintains power plants, and we've decided to remove all their printers, multifunction devices entirely, and switch to paperless across the entire firm. Now, clearly that comes with we claim that as a cost avoidance saving or benefit, but that obviously required a lot of business engagement and mentality change in order to get kind of signed off and embedded across the organization. Another very important element in estimating benefits, I absolutely want to stress, is understanding what part of an organization cost structure procurement initiatives are affecting. Now, knowing how spend areas are reflected or broken down in the various financial statements is key to continuing the meaningful dialogue with finance, and again, to speak the same language. I am currently working for one of the UK's largest holiday park operators who buy static caravans, right? So they may and they do buy the same type of caravan, literally the same model from the same manufacturer, but for two different purposes. One is to be sold to end customers as a holiday home, and the other one is to be rented out to holiday makers who use it for a weekend with a family, a week, a couple of weeks, or however long they prefer. Now, depending on what the caravan is used for, it will be accounted differently in the various statements. So one will be recorded as a cost of sale once the sale to the end customer is completed. The other one will be considered an asset in the balance sheet and depreciated accordingly on a month-by-month or year-by-year basis. Now, understanding this from a procurement standpoint is incredibly powerful, as it helps to relay to the business and to finance when forecast benefits are expected to be hitting the various financial statements. Same goes for payment terms, knowing that changing payment terms, for instance, can have a positive impact in your accounts payables, or working on the inventory, reducing stock in my inventory can have a positive effect on my inventory. Increasing the inventory in my cash flow statement, again, it just simplifies the life with the way we speak with our counterparts in finance. For the last bit, on estimation of benefits, one of procurement's most dreaded moments is estimating the benefits ramp-up curve. Now, i.e., communicating to the business not only how much we're expecting to either save or reduce costs by, or whatever the benefit may be, but when these benefits, as I said before, will be hitting the various statements, right? Getting the timing right is essential to maintaining that element of trust between the two functions. And to do this, we need to provide realistic views to the business and as to when benefits will be impacting the various statements. And to this end, linking back to what I said on the previous slide, it is important to procurement to understand the full end-to-end process and what happens in the various steps and the timing between the various steps, so that the drawing the ramp-up curve and the estimated benefits becomes as effortlessly as possible. I'll pass it on to Waldo to discuss the implementation phase.
Great. So implementation, many of our clients, every client will say, this is where the hard part starts. And it's true. So, you know, how do we effectively translate all the hard work that we did in developing the strategy, to negotiating with suppliers, to sign, to agreeing the savings that came out of that project, but actually translating that down to materialized benefit, realized P&L impact. And the first couple of months once we button up the process, is critical to actually embedding the new agreement within the organization, getting that momentum. And there are several areas. It's a minefield of things that need to be done. Firstly, communicating the new agreements, making sure the organization knows who they should be buying from, what the preferred vendor strategy is, making sure that's just known within the organization. Then there's, if you've made some changes to products or services, ensuring you get the right level of commitment from the organization to prioritize those, whether there's testing or validating of any new items, just getting that commitment. Often, when you start to implement, that commitment can be drawn away to other products, other projects, whether it's new product development. So really getting that commitment to actually qualify those new sources of supply is really important. Holding engineering accountable, getting that commitment to prioritize. Then there's compliance infrastructure, making sure we have the right solution within the business to drive accountability. Then there's actually executing, getting those contracts signed, right? Throughout the sourcing phase, we'll negotiate and agree the commercial terms, but actually getting that paper signed, it's a key step that really shouldn't be left till too late. Then there's the P2P systems, fundamental to ensuring that we have the right controls and data validation for spending. And then finally, there should be some form of supplier relationship management, SRM framework in place to foster the right supplier-client partnership, so both parties are continually getting the most out of the relationship. Tracking benefits, it's the two fundamental drivers behind that delta, whether it's overachieving or underachieving, really are driven by two fundamental things, and that's volume and that's price. So on the left-hand graph, you can see, the green dot is what our expected savings should have been. So when we finished the sourcing process, we expected that we would have spent this, and under 100% compliance, we should have achieved the green dot, right? But actually, what we might be doing is following the red dot, because we might be having some leakage. And by understanding the difference between price and volume, it's really important to know the difference and and really separate those two out. Volumes, we might not buy as much as we thought we would, right? Or we might buy more. But if we see a consistent pattern of underbuying or overbuying, we probably would want to adjust our baseline so we're not continually seeing that deficit or that delta month on month. That might skew other insights. Whereas price non-compliance, that can be easier to correct, right, or to understand, right? It might be harder to correct that we're buying less of something, but it's a lot easier to correct. Okay, you're buying something at the wrong price, either because the contract wasn't in place, or you're buying something with an expedite, or bad, different buying practices than what we knew or what we expected in the contracting phase. Also, the volume variance, if not separated out from price, can often hide the source of non-compliance, right? We might buy a lot more of something that will yield an absolute greater savings, but actually we might still be buying something at the wrong price. So if we don't separate out the two, it's hard to know where to start. So separating out the two really gives us an effective data point for us to go and course correct. It tells us what is different to what we expected, right? And that will allow us to course correct, hopefully up to the yellow line, right? We might not be able to go back to the green line because simply we're buying less than what we thought, but we can certainly improve upon what would have happened if we didn't do anything. Before we go into the two different approaches to savings tracking, every company, however big or small, should be doing some form of savings tracking. Just like you would probably check your bill from the garage when you get your car fixed, or if you went to a restaurant and you got a big bill, you probably would check your bill, right? Everyone should be doing some form of simple savings tracking, right? That could be as simple as checking a PO receipt against an invoice. But most importantly, the solution that's right for you, it must be practical and sustainable, right? It needs to be something that can be maintained and refreshed and is systematic. Now, obviously, just simple checking is probably not going to be right for many of you. So there are fundamentally two different types of approaches. The first one is bottom up. Where possible, this is obviously the best process, because this gives you all the detail to course correct, down to the SKU. It gives you all the answers, tells you exactly what the reason is, what the root cause is, to allow you to course correct. It's a systematic approach. It's always good practice, but it's sometimes actually essential. Whereas top down, this just gives you an indication that you're off. It tells you that you need to go and dig deeper, to investigate, to go and pick up some sample invoices and investigate further, right? But that can be a suboptimal approach. Top down can be a suboptimal approach in several settings. For example, one of my recent clients, which is a large industrial waste management and construction company, while they have a fairly central buying function, they also have 300 operational yards, right? And there is some, local buying at each of those individual yards. It's obviously very hard to go off a mandate and get it right all the time, just with the thou shalt do something. So they obviously need a more detailed solution. But doing this top down wouldn't be that effective either. It would be too little too late. By the time that you started to dig deeper and you went through all of the different possible root causes, you'd probably already be in the second month or the third month, right? So a top-down solution would be something that would be more beneficial there, but it would give you the answer straight away. While top-down may be more relevant to indirects or non-inventory spend, they can also be good candidates for bottom-up. Let me give you an example. Say application development, right, is a good example. There's a mixture of offshore and onshore resources in different grades. So is consulting, right, different roles. So is legal, right? Those are also good candidates for SKU-based bottom-up tracking. Bottom-up is always more feasible. It's always preferable, rather, but can be a lot harder to implement. It might require a lot of process change for the org, to actually get that SKU level data on a repeatable basis. If you're not booking something into inventory, then you won't have the items mastered in the system. So you'll be more reliant on supplier reports to do it bottom up. And you don't want to be reliant on lots of external third-party reports. There's more to go wrong. There's more touch points. It may be that such a high degree of process change in the short term could actually outweigh the benefit of the category in the short term. It could be more investment than the benefits or savings that you're actually going to get by implementing that category. But certainly, in the long term, it should be aspirational. We should be thinking about how can I get to a point where eventually I will be able to track things bottom up. But we also don't want to sacrifice data quality and good spend throughput for the sake of too much detail. Historically, savings tracking solutions, were theoretically very, very, very beautiful and pure, but in practice they fell down because they were so reliant on so many data points that just weren't readily available. And as a result, what that usually meant was within the month, if that was the view we were looking at, on a monthly basis, we would do a refresh. Maybe only half of the company's spend would get into that format. So then you had an incomplete savings tracking tool that only could show you that the variance for half the data, right? So that wasn't great either. But really, there can be a happy medium. Many of the solutions that I've implemented will have a mixture of both top-down and bottom-up. You might have within a program of 10 categories that cover 50% of the company's spend, 7 categories that are done bottom-up, 3 categories done top-down. But the key takeaway is that the solution must be practical and it must meet the specific requirements of the business and allow actionable insights. The key thing here is we've now that we've developed this solution, it's embedded in the client and it's working well, generating insights. How do we actually translate those insights into an action to actually course correct, right? So it's really important that from this solution, a governance structure or a workflow is put into place to make sure that those insights that are generated actually do something, and there's the right governance in place to actually go and act on them and course correct efficiently and quickly. Not only do we need to develop the solution, but we also need to develop the way that the solution interacts then with the rest of the organization. Okay, I appreciate that we've gone through a lot of detail here. This is also, you know, this can also be fairly scientific as a process. But there really are four main takeaways. The first two are really around early engagement. Early engagement is essential. If you do not engage the business early, you'll end up with a lot of rework and waste later on. So early engagement with the right functions in the business, finance, procurement, IT, typically they're the main three, allows us to understand what data points and internal systems are actually needed to do, say, bottom-up savings tracking. It also gives us time to change systems if they do not capture the required data point. It also ensures that as the sourcing teams are developing their RFPs, they're structuring them in the right way to be able to capture the right data points in order to track savings off the back of them. It also ensures that the sourcing team really think about how their savings will be implemented. And ultimately, that means that our savings targets can be achieved. Okay. Then the third one, this is really around proactive management of the implementation, right? A good sourcing procurement team not only sets up the contract, but make sure that all those key activities we spoke about, communication, updating the right systems, putting the right compliance infrastructure in place, etc., are all properly, rigorously followed through and embedded within the organization. And then finally, once we have all of these insights, how do we actually go and drive that accountability down into the organization to do that course correction?
Thanks, Waldo. We're now we're at the end of us talking. We received several questions, which I'll just now read out. One, P&L and cash flow impact depend on type of expense rather than savings type. Absolutely agree. Apologies if that didn't come out as clearly when I was talking about it. 100%. Obviously, the type of saving doesn't determine what his impact in terms of financial statements is. As my example on the caravans stated, it's what type of expense we are talking about and addressing by all means. So another one. Where have you had to use a different approach to baselining as opposed to standard volume times price? Waldo, do you want to take this one?
Yeah. Yeah, a good example is commodity-based categories. For example, we just sourced $100 million of diesel. We implemented an index-based pricing mechanism, right? So the baseline is refreshed very, very frequently, and that's based on it's a should cost, right? So rather than expected volumes times fixed price over the duration of the contract, it's a constantly refreshed should cost model. The actual model was the fuel index minus discount plus freight at the site level, right? So that was something that we were constantly updating the baseline model in the back of the tool to do that. So yeah, commodity-based categories with price index mechanisms usually have should cost models for the baselines as opposed to just static prices.
Okay, thanks. How about linking your budgetary data on an individual ID or P&L line item level as a baseline for all of procurement work? That's a very interesting one. I don't know if you will have any thoughts on it. However, so I would say that is the ideal scenario. However, that requires procurement to be 100% ingrained with the business, and especially as earlier on as possible, so that they are part of that conversation and they can effectively build the output of their sourcing activities into next year or next period's budget, and that way build the budget from bottom up. Paul, did you have anything you want to add to this one?
No, I think that's fine.
Which tools do you recommend for savings tracking? So there are many solutions out there, many providers claiming they know it all and they figured it out. The truth is there isn't an off-the-shelf solution. Every organization is different in the way their IT architecture is structured, the systems they're using. So you'll never have one solution that will fit every client, just because of how breadth and differences in across the multitude of organizations out there, the size, the complexity of the ERP systems. So you really need to define what the key metrics and key requirements are in terms of who will be using the solution and to what end, and build the solution around that. Clearly, it doesn't have to be extremely fancy or extremely expensive. It can be worked off an Excel spreadsheet, provided, again, that the structure is set up properly. We obviously recommend, being in 2020, that we move away from that and we automate as much as possible. But I absolutely encourage you to obviously either reach out to us if we want to have a more in-depth conversation about this, or just other players in the market that can deliver some customized solutions.
Yeah, I'll add to that as well. Obviously, I'm obviously not biased at all, but again, you know, one of the key takeaways is as we're developing these solutions, this should not be done in isolation away from the sourcing. You know, some clients have asked us to kind of put in place a roadmap and a design. So, you know, I get into the requirements phase. So, you know, what systems are required, what data points are needed. So, you know, what data points do they need to capture in their systems? What solutions makes most sense? And then they want to go and do the actual development of the system themselves. But there are so many touch points. There are so many drivers that make this successful, right? So one is actually setting up the sourcing in a way that you are going to be tracking the benefits and getting the data in the right format later on to actually do the savings tracking. Two is, you know, when you're doing the sourcing itself, engaging the business at the same time for all the reasons we talked about, getting the business engaged to do the necessary changes in order to do good savings tracking. So really, it shouldn't be done in isolation away from sourcing, unless you're dealing with a couple of simple categories. But if you're really looking at multiple categories with very many different characteristics, then this should be done at the same time that you're doing the sourcing. It's very hard to successfully implement something which is pure, you know, which is done completely in isolation from the actual sourcing itself.
Thanks. This one is addressed to you specifically. So I have worked closely with finance in retail. At times we have new products replacing the old ones, which are quite different. So the new products are quite different to the old ones. In your experience, what good ways have you seen to record the savings in this scenario from this type of sourcing activities?
Well, my assumption is the product is different, but it's doing the same thing. So it's in the same way that maybe you might source and agree with the engineering change, you know, for say sourcing electrical components, that you'll switch away from say switch A to switch B, or cable A to cable B. As long as, you know, as long as it's there as the same, as long as it's a functional equivalent, if you like, then you know, this is something we do very often, right? Which is where we link our part numbers. So so going back to what Luca was talking about, getting the ramp up right. So, you know, once we complete a sourcing process, we develop a transition plan, right, where we work with the client to say, okay, we'll leverage the existing components over the next 3 months, but during that 3 months, we'll work with the engineering teams and quality teams to qualify the new item. So what we'll have within our transition plan is a target start date for when we should be able to buy that new qualified source. And then what we do within the data set is we link a part number. So what we can see is for the first 3 months where we're still meant to be buying that existing part number, it comes up as compliant. But once we hit that 3-month threshold, we should now be buying off that new part number. So if we're buying the old part number, it'll show up as a source of non-compliance. So that's something we pretty easily handle within, especially, the areas that I focus in, which is industrials and manufacturing. There's all sorts of part changes all the time, right? So we're able to link the new part number with the old part number, but also with the variable of time. So hopefully that's answered your question.
Yeah, so I definitely agree with you, Waldo. Or depending on whether this is an isolated case or a trend, a savings tracking solution could help us identify this as a trend and therefore act on it, as you were talking about earlier in the tracking phase, acting on it and either bring the new products into an existing contract or try to kind of carve them out and group them as a different initiative or subcategory, depending on the case.
Yeah, so I'll just add to that, because I'm not sure if someone's asked this, but it's probably worth mentioning. When we do the baselining, as we're about to go out to market, we will never capture 100% of everything that you might buy, right? Either because we just don't know, right? Again, I'll be a little selfish and talk about industrials and manufacturing, but often there is a high turn on SKUs, right? It might be possible that that business, because they're generating different products every year, are buying different things than they bought last year. So it's quite possible that resulting from the sourcing process, you might not have every component that you are going to buy over the next couple of years under contract. So what we can do is, as we get that spend data coming through every month, we can isolate out items that are bought repeatably and that are recurring, and we can actually see the types of items that we're spending lots of money on that currently aren't under contract. And then that allows us to say, okay, we're buying these 10 things quite frequently. We should now go and put those under contract.
There's one final question. What do you think is the most challenging part of the process you described?
I think it really depends. I think it depends on the client itself. It could be just engaging the business, right? It could just be, this does not work. This is not just a procurement initiative. This is procurement and finance and IT. Depending on the complexity of what you're doing, right? If you're in a client like one of my recent ones where, only 20% of their spend they even captured at the item level, there's a significant amount of process change that's needed to get the data in that format, right? So you can't do that in isolation without working with IT and the systems programmers. So if you don't have that good engagement with them and you don't have that sponsorship, if you like, from the business to get that time and commitment, then it's going to be really hard. You'll be working up against it all the time. So engagement can be one thing, agreeing and really just getting the right level of data. In an ideal world, you're not reliant on external reports, whether it could be a supplier report, right? Because it may be that in the short term, the whole business isn't going to change to capture all the detail at that SKU level. So you may be reliant, but going back to the point about early engagement, right? Why it's important to develop this solution as you're doing the sourcing. One of the things that we do when we're negotiating with suppliers is we already socialize all of the relevant data that we are going to need from them as a partner in order to effectively savings track. The benefit to them is that if there is good compliance, they will get more of the volume. So there is a benefit to them. So that can be a challenge as well, sometimes it's inevitable that we have to rely on external data reports. And it's just putting the right process and busting that bit up to make sure that, every month we're getting what we need to have good spend throughput in the right format.
Great. To build on that, I think from a technical standpoint, I see as we move from left to right on the across the 4 steps we described today, the process gets harder and harder. So procurement are typically better at the baselining calculation as estimating part of the process, and tend to find it harder to get to nail it down in terms of tracking the benefit and relaying insightful information back to the business. Whereas from a process standpoint, I absolutely agree with you, is that stakeholder engagement, because we're talking about change management effectively, is a change of mentality and step. And so having engaging both finance and business all the way through the process is very challenging. Absolutely. Very well. So we don't have any further questions. So I will just effectively, this concludes our webinar for today. Should you have any further questions or want to discuss any particular challenge you're facing, benefits tracking, or more broadly about procurement, obviously feel free to reach out by either email or phone. Thank you, Waldo, and thank you everyone for attending today's webinar.